I mean, I'm just trying to do a podcast here and play games with this Blue Label Sumatra. And Eric, I'm talking to myself. That's okay, because this is how I spent the first 2 years of Jazz Wealth, just sitting here talking to myself with nobody else around, answering emails, making videos by myself. And here I find myself again. By myself. Only everybody's using my stuff now. Ooh. That's why I had this. I was like, last time I went with the hairspray. This time, manliness. Huh?
Man.
No hairspray. Well, there is hairspray, I guess. Hey, welcome. Do we call this FinTips still? Yeah, FinTips, right? Friday FinTips.
Yeah.
Friday. It's a video. We're talking, right?
Chat with Jazz.
Chat with Jazz. Yeah, there you go. We had been bouncing ideas off each other, and that was about an hour ago. So I feel like I might be a little off track, but you pull me back if I forget something. I did prepare something for you guys today, and for Eric.
Yeah. I want to see what you got, and I got something for you too. So we'll take a look at this and see what we got going.
I hope it's candy. So we are we're talking about dividend portfolios. We get a mixed bag here. A lot of people like to look at only dividends, and some people say, look, I want growth and I want to focus on that. But I want to kind of go through a few things with the data that I find to be something that people should know before you start putting together a dividend portfolio. And so first thing I did is I put together a completely random dividend portfolio. I'm not joking. I did not handpick these. I ran a filter that said, hey, I would like to, I'm going to look through all the dividend stocks, and then basically just told Excel, pick 10 random names off the list. So on the screen here, what you see at the moment is what it came up with. Now, I chose to build a portfolio. You want to turn this a little bit?
Yeah, I got you.
I chose to build a portfolio where each position had 10%, so 10 positions, that's 100% of the portfolio, and it spit out these names. Some we know, some you may not know, Kohl's, H&R Block, Gap, you can see the name there. So what I did is I said, well, if hypothetically someone just randomly let Excel pick 10 random dividend stocks, let's see how they would perform. And so what I did is I went over and plotted the performance. And right now we have year-to-date set up here. If you look up to the top, you're going to be able to see year-to-date. Obviously, everything's pulled back this year so far. But let's put the S&P on top of it, although you really shouldn't compare a dividend portfolio to the S&P. A lot of people like to, so we will. Year-to-date, you got the random dividend portfolios holding up nicely. It's up 3%. This is, again, totally random, not cherry-picking. I have no idea what was going to happen. And then you got the S&P down about 12 at the moment, but rallying back. Okay, that's year-to-date, right? If we start zooming out, up at the top here, what I'll have is, I'll have the purple is always the random dividend portfolio, and orange is the S&P. So up top here, what we've got is the returns, and then the annualized returns. So we're just picking random periods here to go back. And notice what happens as you start scaling out. This is why you don't compare a dividend portfolio to the S&P. It's not supposed to keep up with the S&P.
Yeah.
It will not. There'll be moments where, if I were to go 1 month and only look at the 1 month performance, it doesn't beat it there. But if we go 3 months, almost, right? So you could zoom in here and make an argument for the dividend portfolio is better. But as an investor looking longer out, look, you're lagging behind. Annualized 9.75 versus 12. This is on a total random portfolio. Eric, thoughts?
Yep. And so being that it's a total random portfolio, I'm excited to see what you got next on things, see a little bit more maybe of a fine-tuned one. At the same time, it was a trend for quite some time. And what people aren't realizing when it comes to YouTube, let me set my coffee cup down like I said I swear I'm going to do. So here we go. I wanted to make that official.
Thanks all.
So the thing is with YouTube, a lot of people put videos out for the algorithm, and it's going to grab it, and it's going to keep going. So speaking of that, hit the thumbs up button. I think we're supposed to say that.
Hey, thumbs up. Be sure to like and subscribe. Huh?
But the idea is whatever's the trending topics is what's grabbed. And dividends tend to be one of those that sometimes gets to be trending. And the danger with that is the younger person wants to jump in on dividend stocks and creating what they call that passive income. The problem is just what you're showing in that chart. Really, for a young person to focus all on dividend stocks just looking at this alone just shows you why you don't do that with that chart. But I'd love to look a little bit more. I know you have a little bit more on the chart, and also then talk also for retirees as well, because that's one that retirement people like to focus on, is sometimes more of a dividend style or partial dividend style portfolio. So let's take a look, see what else you got there.
Well, so this is interesting because if you are in or around retirement, yes, this is the game you want to play, right? You want to pull back less than the market, and you obviously don't need the full growth of the market. But why you want to pull back less than the market is exactly what you're looking at on a screen. Let me go 1 year just so we could see the last of the market, or the start of the market pullback here. So throughout the year so far, the market fell just about 20% there from highs. And so you have 6 months, 7 months really worth of pullbacks, and you're still positive. That's important because you're making withdrawals, right? When you're retired, you don't need to be making withdrawals on the way down. That's the worst feeling in the world. So that's, for me, the retiree, yes, this is totally perfect. For the kid, the younger kid, you're watching TikTok or Instagram or whatever, it's easy to fall for dividends, thinking passive income, hint, all those buzzwords, right? But you're losing out on growth in the long run, so don't be 100% invested there. The second thing, and then I'll get out of the way.
Time. I'm ready for that.
Yeah, it's about time now, son. So the second thing I did is I said, we'll go over here. I said, what if I had the magic capability to pick the dividend stocks with the highest yield, and I knew they were going to be the best performers? In other words, I'm intentionally cherry picking here and saying, what if you were just awesome and you got the best returns? So what I did is I used the entire Russell 3000, so we can get everything in there, and I said, well, they got to have dividend yields that are in the upper 10% of all the stocks in there, because I wanted to make my list smaller. And then I said, okay, now I want to have the 10-year total returns. You could do annualized returns if you want. It's just, this was easy to plot. And so I said, okay, this is the best performer. Arbor Realty Trust, 8.8% yield, 634% gain over 10 years. So it doesn't have the highest dividend yield. I wanted to rank by performance. In other words, this is the best all the way through, I wouldn't say the worst, but the not so good, right? So I did not pick the highest yielding stocks. A lot of people look for that. Let me go with the highest yielding stocks. I did not do that. I wanted the best returns. Again, assuming that I already knew, like in the past, that these were going to perform well. So now let's go over here to the chart, and we'll leave the S&P on there. Well, I got to take it away for a second, otherwise it'll be purple. So we want our best yielding portfolio to match up against the S&P. Well, now what do we have, right? Over the long run here, it looks like it's beating. Oh, wow, look, we're above. Visually, we're above. This is much better than what it is down here. But go like this for just a second. You got the annualized returns of 17% for the best yields portfolio. This is flip-flop from the other way. And you've got the S&P total return of 12.8%. Now notice what happens if I go 10 years. There you go. Okay, still beats. Not by as much, but still beats. You go, well, this is awesome, right? 3 years. Beats by a considerable amount there. That's all going to be Arbor Realty Trust. And then 1 year, what do we got? Still beats, but by just a little bit. We have more volatility in exchange for that return, the total return, by the way, I should say. And you're getting the dividend and you're getting better returns, but that's the absolute best you can possibly do. So we went from random to the absolute best you could predict the future sort of thing. And overall, you're beating there. Is that going to happen, right? Not only that, I'm going to play one more little game with you here. We're going to say pull back off of highs just to show volatility here. So what I'm plotting here is every pullback, the severity of every pullback. So the best yielding portfolio ever on the planet that you could build, the purple, look at this pullback. You have to be willing to be down a lot more than the market in order to gain more than the market. Everybody says you can't beat the market. You could beat the market on the way down, of course, and you could beat it on the way up, but you have to be willing to withstand, oh my gosh, 60% drops when the market almost fell 30%. And in every case here, look, every case of a pullback, you have where you're outperforming to the downside. Now, I can't flip this, but if I could, you would see you're outperforming to the upside. So would you do that, by the way? Let's say you're retired and you wanted the highest growth with the highest dividend, and it was possible. Would you do it?
If I'm retired and if we have the dream chart, I mean the top 10, I think what we should have done there, something to consider too, though, is a good comparison would have been taking the top 10 yielding stocks in general, not just dividend stocks, out of the Russell and compared that. Then I bet you would have smoked the dividend, in general, just with things. My personal view on this is in retirement, I would have a hard time stomaching those because at that point, those are your retired years. I mean, I talk to clients every day in this market right this second. One of the biggest concerns is, well, hey, I've lost money. I've lost money. Well, if you're investing solely for the dividend, if you're living on just the return of the dividend, that's one thing. But oftentimes people are still having to withdraw some off of the stock as well as the dividend. And that's not being always taken into consideration here in this. And so there's a lot more that goes in with that people aren't realizing, because when we talk about, the total return is the dividend plus the actual return of the underlying stock. That's a big difference on just saying, hey, we're just focused on just the dividend, because just the dividend itself is totally different. Hey, I'm just going to live on the dividend from the stock, then really don't ever watch the portfolio itself. But it's one of those that a lot of retirees do love, the dividend portfolio. And in the end, though, the volatility is something that they truly can't stomach if we try to build that out.
Well, and so there's a lot of different directions we could actually go with this. And one of the things that I tried to do here, just thinking, was if I did a random portfolio in the S&P, then 10 stocks would be fine. Figuring in the S&P, we got larger market caps there. I mean, you got Verizon's like a $20 billion market cap versus what I built for the best performing dividend stocks, which, what was it, Arbor Realty?
Yeah.
So Arbor Realty, okay, that's 1/10 the size of Verizon, right? So I should have put market cap on there as well to show, okay, you get 20 stocks, you may feel diverse, but when it's hitting the fan, so to speak, you're looking going TFS Financial versus Verizon. What would I rather own? You could see some of these stocks just drop off, and that's the end of it. So you got to be able to stomach that, and very rare that we come across people that can stomach that.
No, absolutely.
Yeah.
I even actually did it here. I jumped into NestEgg, and so on NestEgg right here, what we're looking at is a dividend portfolio. So I built out Clark Howard and Mrs. Howard.
I thought he was our client for a second.
I've got them set up, and basically, if I go over here and I look at their profile, what we've got in their net worth, 1.625 here, and they're going to be living off of just the income needed in retirement, $7,000 a year. Can they do it? Yes, they can do it based on what I've got built out here, but I invested everything in a dividend portfolio. It's definitely doable, but what I found extremely interesting is if I go over here to our investment tab, it'll actually break down the annual return, which is 8.8%. Now that's total return. So just what we talked about, that's including dividends. So let's say maybe the stock gets, a 2.8% dividend, but then a 6% return. Total return, 8.8%. But looking here, standard deviation at this is 16.1%. If I take this and I adjust this over here on my target allocation, let's just say to a growth portfolio even, a 70-30 is what we're looking at. Your standard deviation, yes, your annual return is not quite as much on this one, but your standard deviation is only 11.7%. In retirement, we have to look just as much on that standard deviation as we have to look at on the actual annual return because of the concern, the emotional play in this.
Oh, yeah.
We want to remove emotion, but the reality is the emotions are there. We can't just completely block it out. I mean, that's like telling my wife, hey, don't worry about it. Like, that doesn't work. It doesn't work that way. If I tell a client, don't worry about it.
I can attest that doesn't work. But to be fully transparent, there's actually the revenue side of it for us. Like, no other advisor talks about this, but I want you to have the least amount of volatility with the most amount of growth, given your position, your profile, what we learn about you. Because if I don't do that efficiently and Eric doesn't do that efficiently, then that means we don't grow as much because you didn't grow as much, but you still have to suffer the volatility. So if we just threw you in an ETF, then you get that volatility and that growth. So we look at it from a business standpoint and say, if it means we have to break apart our funds and build something a little different to give them less volatility but more growth than what they currently have, that's a win-win. So it benefits us to do it. It benefits you because you don't lose sleep over, every night of watching the volatility of your portfolio. Yeah. So I guarantee no other advisor has said that, but it's business. We want to make as much as we can, and the only way that happens here with us is if your account gets bigger. If it doesn't get bigger, then we don't get bigger either. It doesn't work.
Yep.
And I don't think that's bad. I think people should say, that's the goal. I mean, it just shows that you're actually, yes, you're working to make that account grow instead of just whatever advisors do.
Well, that's the ultimate goal. Working as a fiduciary, you got to realize, advisors are in it to win it together with the client, because if the client does better, the advisor does better. But if the advisor doesn't do good,
not all of them.
Yeah. Well, but you get the ones that just sell the guarantees and the insurance and that kind of thing. That's not the case. It's just like, hey, let me just promise them the world, but they're going to make their dollar and go on their way. Yep. Going back real quick to this too, one of the biggest things is with the standard deviation, looking at this, what you have to realize is in retirement years, kind of what Dustin was showing with the charts, is that standard deviation or even that drop is the withdrawal strategy. Because once you are into retirement and you're withdrawing, the more your money goes down, the more you're having to withdraw from at a lower point isn't always the best. And that's where, that's why planning is such a necessity, and really trying to figure, because I'm just throwing a dart out here with this one plan that I just made up. I didn't try to sugarcoat anything. I didn't change anything. I just plugged it in, said, hey, throw it into a dividend portfolio. But if we start adjusting things and we come up with a different portfolio where maybe there's not as much in assets, and the dividend portfolio looks great on the return side, but the standard deviation is more, and when they're withdrawing and the market is down, that's going to hurt them a lot more long term.
Yep.
And so that's something that has to be considered with these dividends. So,
I'll throw in one last thing there. It's easy to say, oh, there will be periods where the market is falling and you have to withdraw money from a falling account. So it's easy to say that and go, yeah, all right, I get the withdrawal rate when the market falls. I understand that concept. But to actually put numbers behind it, that's the cool part. When you can say, look, if you're in this portfolio and it's this volatile, there will be periods of time where your account balance will look like this, but you need to take the same amount out. Here's the long-term effect of that. And that's the geeky stuff that we like to do. But so many of the younger kids anyways, I notice, they don't think about that, and they shouldn't. They're not there. But if you're right there at retirement, you're near retirement, maybe a couple years into it, whatever, that's the kind of thing that we eat up, because it means that's a return. So remember I was saying a second ago, if we can get your account to grow with the least amount of volatility, we both win. Well, if I can show you that you end up with more money by taking that approach as well, that's a return. You ended up with more dollars, not from an investment, but from us strategizing. When that happens, then I'm like, okay, we added value. That's good. We can take a little break here.
Yep, that's it. And so in the end, what was the movie that was out? What was that? Gosh, Twilight. It was Team.
Never heard of it.
It was Team something and Team something else. Let me know if you know this in the comments. Please tell me. There were different teams. So are you Team Dividend or are you Team Mix? Maybe some dividend, not all dividend, especially for a retirement portfolio. What do you got there?
Yeah, there you go. I like it. Well, in the meantime, we already gave you the support, the subscribe, thumbs up, all the great stuff there.
Yeah.
A little longer today, but let us know what you think and everything, because we shared some extra data that we normally don't do. You guys enjoy your weekend, and we'll be seeing you soon, right?
Yeah, that's it.
Keep it rolling.
All right.
Oh my God, with that.